Okay, hello and welcome to today's event. I'm Jason Gumper from msdynamicsworld.com, and I'm joined by Scott Caudle, CEO of SK Global Software, and Patrick Sheehan, the Chief Designer of the Revenue Automation Solution. As we get started, please know that you can add your feedback and ask questions using the Q&A block that you should see to the right of the main presentation window today. Scott and Pat will be leaving time at the end to take all of your questions. And without further delay, please allow me to welcome Scott to start things off.
Thank you, Jason, and good afternoon. Thanks, everybody, for joining the webinar today, and we look forward to sharing some important information with you about Accounting Standard 606, IFRS 15, and how this relates to your implementation for Dynamics AX. So thanks again. First thing I'll do is just give you a quick background on SK Global, talk to you a little bit about that, and then we'll jump right into the meat of the presentation as it relates to the standard and how we see that working in AX. So for those of you that know SK Global, we've been around since 1994. We've got offices in the US and in Europe, and we focus heavily in the global banking and treasury automation space for Dynamics. We design our software for automation, so we look at the business processes involved and try to automate those as much as possible. We've introduced revenue automation as our new product suite. We'll be talking about that today. And we're also looking at expanding into channel automation in the future. Our solutions are optimized for both small to enterprise companies, and they're fully integrated to Dynamics AX. As you can see, we work extensively with a lot of different treasury bank systems and banks from around the world, about 300 in total that we've worked with. And we're very involved with Microsoft in terms of the Partner Advisory Board, the TAP program for AX7, supporting the LCS curation process. We work closely with Microsoft Consulting Services, and we've been awarded President's Club 11 years running. We do partner with many partners in the community. We have over 400 active partnerships, many of the resellers that you're familiar with. We work with on a day-to-day basis in helping their customers implement our solutions. We are very closely aligned and pay attention to the different governance boards and organizations out there, whether it be for Treasury or in this case for the webinar today, FASB or the IFRS, International Accounting Standard Boards. For those of you that are familiar with some of our other solutions, I won't spend a lot of time on this, but we do have a full breadth of solutions around the whole electronic banking and treasury automation space, which we can provide information to you about that if you would like to send us an email. Today's focus, of course, is around the revenue automation area, and we will focus in on each of these different areas of the solution. Later in the presentation, we'll actually do a demonstration of some of these areas, but we've broken it into essentially 3 pillars, if you will. The first pillar being advanced contract management, where we handle all the sales bookings and the contract setup, definition of the contract performance obligations. We have an area for billing automation, which handles all of the billing, including subscriptions billing management. It can be designed to support an unlimited number of addendums, bill tos, deliver tos. It's very flexible in terms of how it's defined. And then, of course, lastly, we handle the full revenue recognition automation, which supports all of the legacy rules around VSOE and the new rules that are available for 606. And we can also provide forecasting information and dashboards and metrics, which are very important. Most of the time when we see an implementation, we're looking at Dynamics AX as the core, and then frequently we'll be implementing an integrated solution where either Dynamics CRM, maybe Salesforce.com, an e-commerce system will be integrated as well, and then frequently a client provisioning or delivery system that would indicate when things have been delivered or where they've been activated. So this is the lawyers made me do it slide. Essentially, we're not holding ourselves out to be your CPAs or auditors, and if you have specific questions around compliance, you should direct those to your certified accounting professionals or auditors. All the information we're providing here doesn't have any warranties as it relates to your compliance, but it's purely for education and awareness. So with that, further ado, we'll get started into a little bit of background on Accounting Standard 606 IFRS 15, which is also known as Revenue from Contracts with Customers. This is the new converged revenue recognition standard between the collaboration efforts between the FASB and the International Accounting Standards Board. The goal is to try to create a more consistent and streamlined standard, and it does replace all of the previous guidance around the industry-specific guidance from the FASB. It has been under convergence for well over a decade, which seems like a long time, and it was released in 2014, but the effective dates for the new standard have been continuously moved out, but these are the dates that feel pretty comfortable are going to stick. So if you're a U.S. company, if you're a public company, you'll have by the end of 2018. If you're a private company, you'll have by the end of 2019. And if you're following the IFRS standards, most of those companies will be required to come into compliance by the end of this year or by 2017. So what is this new standard in general? What it is it, in terms of the impact, if you will, between the old standard and the new standard, and setting aside software for a second or how this might work in your ERP, the primary impact is going to be related to the timing, the manner of which you recognize revenue, and possibly the value which you recognize revenue for any company that would be covered under the new standard. So it will have an impact. The question is how big of an impact, and that'll vary somewhat between the types of transactions you do and the industries that you play in. So relative to industry, these are some industries that are highly impacted by the revenue standards. They were impacted by the old standards, and they're still impacted by the new standards. Some of those noteworthy industries include high-tech manufacturing, software industries, media, publishing, any cloud-based or subscription model business. A telecom business, of course, would be affected. And then there are certain business issues within the more horizontal industry segments that are covered under the guidance. So if you're in the service industries, you have contract accounting issues. If you're in manufacturing, you may be dealing with warranty accounting. If you're in distribution industries, you may be dealing with packages or bundles, and all of those, to some extent, are covered under the new standard. One of the other areas that is covered specifically in the new guidance is related to licenses or IP. So there is industry-specific guidance provided in this area. Those would be things like software, patents, media, entertainment, pharma, life sciences, retail, and CPG, and you can see the issues that we've noted here on the slide. But these all have specific guidance in the new standard. There are some things that are not covered. This is not a complete list, but these are some of the noteworthy ones. So leases are not covered under the new standard. Insurance contracts, financial instruments, guarantees other than product or service warranties, which I mentioned on the previous slide, and then non-monetary exchanges between entities. If you're familiar with the oil and gas industry, they do things like the exchange contract. That's not covered under the new standard. So what is the definition, if you will, of revenue from contracts with customers? And this is a sort of a paraphrase definition that I've developed for the presentation here, and I'll just read it to you. So an enhancement of an entity's assets, an entity here would be like the vendor, or settlement of its liabilities resulting from the delivery of goods and or services as contracted with a customer in the course of the entity's ordinary activities. So if it's an extraordinary item like a gain or loss in a sale, that would not be covered under the definition of revenue, but if it's in your ordinary course of business, it would be. Okay, so not knowing, of course, the background of the different people on the phone, some of you may have already done extensive research into the new standard, but for those of you that haven't, I have a quick review here of some of the key points. So the new revenue standard model follows essentially a 5-step model. And the first step is to identify and track the contracts that you have with your customers. The second step is to look at those contracts and determine what are the distinct performance obligations that you have to live up to transfer goods and services on the contract. Third one is to look at your transaction price, or how much is your contract being sold for, and then allocating that price to the different performance obligations. For those of you that are familiar with this standard or the old standard, there was a terminology called VSOE, sometimes referred to as VSOE, which was a somewhat difficult standard to follow, and that was the requirement for price allocation, particularly for software companies. That has been superseded. There's some new rules there around standard pricing, which make things a little bit easier. We're going to talk about that in a few slides and in the presentation later. And of course, the last step is to actually recognize the revenue either as a point in time or over a period of time, depending on the type of contract. So those are the 5 key steps. So what are some of the challenges? So I'm not going to go into great detail of all of these, but there are a number of challenges that you have to deal with when you're trying to comply with the new revenue standards and even the old standards. So I mentioned VSOE. That was always a difficult area for people to comply with. We now have some new guidance there as it relates to standalone pricing. You still have some things to keep up with, but it may result in being able to recognize revenue sooner. Contract modifications is a big deal. So defining how the contract is supposed to be in the very beginning in terms of what are the performance obligations, what is the pricing, and so forth, can be done. You could do it on an Excel spreadsheet if you wanted to analyze it. The difficulty comes into play when the contract starts changing. And so if there's a change order, or if there's a change in price, or if there's a change in scope, all of those things have to be looked at and evaluated under the new guidance, which can be time-consuming. Some of the other things would be options for additional services and variable consideration. So if you think about it, if there was I'll give you an example, so I won't name the name of the software company, but there's a very large software company out there that sold an operating system, and in their sale, they indicated to their customers buying it that they were going to offer them a free upgrade to the next version of the software. So essentially, they're giving them an option for additional services, and those services, in terms of how much that price was going to be in the marketplace, had not yet been defined. Under the old VSOE rules, that required that big software company to defer all of the revenue from the sales of those products until they could define pricing under the upgraded price, which is not a great place to be. The new guidance is a little bit easier, like I said, and you can and you do get some relief there. The next thing, contracting costs. So if you think of legal expenses or sales commissions, those are things that fall under contracting costs, and those have to be dealt with in a specific manner, amortizing those over the life of the contract, for example. The principal versus agent relationship, so whether or not you're going to report the sale as gross or net depends on how what your relationship is with the customer, whether it's a principal or agent relationship. And then financing activities and financial disclosures. Financing activities, it would be if you're extending terms, say, beyond 1 year, then you could be subject to carving that out as a separate performance obligation and allocating a portion of your contract price to that. So again, this isn't intended to be a class on revenue recognition, but certainly giving you an awareness of some of the different challenges that you face when you look at these new rules. So I'm going to provide this one quick example. So this is an example of VSOE, and this is specific to like a software company, and there was a terminology used for PCS, or post-contract support. So the current guidance, the legacy guidance, it doesn't recognize a distinction between the various elements like software maintenance, support, unspecified upgrades, etc. Under the new guidance, it requires you to analyze and separate all the distinct elements of the PCS arrangement. Under the current guidance, you're required to establish VSOE in order to separate the elements and recognize the revenue. If you can't establish VSOE, then that could result in revenue deferral of the entire arrangement. Under the new guidance, however, it requires you to separate the elements, and then you can allocate the transaction price by the relative standalone prices, which the result of that could be an acceleration of revenue recognition. So again, this was just one example of how the new standard versus the old standard works in a particular situation, which was the post-contract support for a software company. So let's kind of shift or pivot, if you will, to Dynamics AX. So with that background of the new standard and some of the different industries that are impacted, when you look at implementing an ERP system, and particularly revenue recognition, you could certainly handle a lot of these business issues either through an Excel spreadsheet, a manual workaround, etc. So what we look at when we look at companies that are more than likely going to be significantly challenged is we look at companies that have a high transaction volume of contracts. So if you deal with a customer or a mini number of customers and there's a large volume of transactions there with contracts, then you're probably going to want to look at how to automate that. The second thing we look at is how often do the contracts change. So here's a good example. Let's say you're working with a telecom, and a telecom has tens of thousands, hundreds of thousands, maybe even millions of customers. Those customers change their contracts all the time. I mean, if you're familiar with cell phone, probably most of the people on the call have a cell phone. You may be changing your contract once every 2 to 3 years. So that can create quite a bit of churn in your setup. Some other challenges that you'll be faced with is how do you carve out these different performance obligations on these contracts and account for them? If there isn't a specific place in the ERP system called performance obligation, then you have to figure out how are you going to be able to account for those, whether that's going to be through an account category, through some mechanism, and we're going to show you later in the demo how we can help with that. You're also going to be you're going to need support for packages or bundles or offers. In some ERP systems, they call this a sales kit. Dynamics AX doesn't have a concept of sales kit specifically. We have, and can show you later, some capabilities that can address that. You're going to need support for the VSOE or standalone pricing requirements, which are part of the standard. You're going to need support for price allocation. So once you've established the transaction price and the different performance obligations, how are you then going to allocate that price? These are all things you'd have to do in the ERP. You may have subscriptions management issues. So if you have a really basic subscriptions model or contract that may not be that difficult to deal with, but many, many times if you look at how subscription contracts actually work, they have termination clauses in there, early termination clauses. They have proration issues if you start the contract at the beginning of the month. They need to be able to handle contracting to multiple entities, possibly different bill-to entities or deliver-to entities. And there's a long list of things here that you have to deal with. So those are some complexities that you'll end up seeing in the subscriptions area. And of course, in many cases, your subscription periods are going to be different. So depending on the industry, you may see daily billing, you might see weekly billing, you could see monthly billing. It just really depends on the industry. A couple of other challenges that you'll be facing. Very typically, orders or contracts, if you will, come in from various sources. They don't all come in from the same place. So they come in from either a sales order system, a CRM system, an e-commerce system. Any variety of sources or more than one source would have to be potentially brought into the ERP. You might have to deal with things like co-termination. Again, we talked about that a minute ago, where if you have multiple contracts that you're doing with a customer, you may want to consolidate those contracts and then have a renewal date that lines up, the same anniversary date. You may need to be able to support discounts or rebates and you most likely will need to support some kind of forecasting as well. So these are all challenges that we would see that would be pretty typical with an implementation of AX. So with that, I'm going to kind of pivot back again over to Pat, and he's going to walk you through some specific examples in the software. And again, we're going to be walking through this advanced contract management piece, the billing automation and revenue recognition automation pieces of the software. And with that, I'm going to go ahead and shift over to Patrick and make him the presenter.
Good morning or afternoon, everybody. Happy to be here. I just saw that I just was made presenter, so once again, good morning. I am the chief designer of the revenue automation module that we see here today. We're going to talk about a couple of examples and demonstrate a little bit about how we would set that up in the product, and see what hopefully get a little bit out of it. We'll talk about some things that may suggest different types of treatment under the new guidance, especially over what we call legacy guidance, as well as even within itself. Our first example here is a high-tech example. We're looking at elements that have been sold that would include equipment, embedded firmware, which in our case and for purposes of this is really being treated as something that is required to make the equipment work. It actually isn't a standalone product in and of itself and isn't sold separately by the entity making the sale. We've got a subscription to management software related to the equipment, and an explicit warranty. And an explicit warranty is important to us because unless it's explicit, we really can't treat it as a separate performance obligation. It would be included with the underlying, probably continuing or the post-contract support very often, or it would actually, that would, under the new existing guidance, it would be part of post-contract support. Under the new guidance, it really doesn't get treated at all from a revenue recognition standpoint, but it would be subject to other parts of the codification, particularly those related to accrual of costs related to warranties. So that's what we've got here. Just a loose example here, and just from a conceptual standpoint, what's important is a couple of things. One, a performance obligation. You'll see here that the equipment and firmware are treated as part of the same performance obligation. That has to do with the fact that while the equipment is a distinct element, the firmware is not, because it's not sold separately. So we would treat that as as part of the same performance obligation. So they're linked together. They'll be recognized at the same time. The warranty is a separate performance obligation, largely because it's been explicitly stated in the contract. And the management software is also an explicit or distinct element on this contract, and forms up its own performance obligation. In each case, we're going to be billing this billing at the beginning of the contract. It's an annual contract. And we'll see that we have a transaction price, again, an important distinction in the new guidance. You'll see we don't have a transaction price for the firmware. It's included with the equipment, and the warranty and the management software are out there. The relative standalone pricing and what we'll actually be using, and what you'll see in the software is really saying that we'll actually have $3,400 in the equipment, and then the firmware won't actually be accorded revenue again, because it's incidental essentially to the equipment. We see, and then the warranty and the management software will be accorded revenue accordingly. The amounts that we're going to see in the software are a little bit different than this. So, but the allocation percentage is created as a relationship between the relative standalone price at the line level to the relative standalone price for the entire bundle of product that we're selling in this instance. That forms up that percentage, and then that's applied against the total transaction price to come up with the allocated revenue amounts for each individual element, and in aggregation to the performance obligation. So let me bring in the software so we're going to walk you through how these setups occur. Okay. So most of you should be pretty familiar with AX. So here we have our advanced the revenue automation piece, the advanced contract management portion of that, and we'll see that we have a fair number of menu items to deal with here. We're going to start by looking at our contract tree view, and then we'll walk through each of the elements. This is nice. We can break things down by customer when we do this, and I think I've got the contract I want to look at built into this customer. See that I have two contracts out there, and then in this contract I have two addendums. One's in a created state, the other one is in an active state. And then this contains the four elements that we looked at. So this makes up our hierarchy. And when we started to design this, we really thought hard about the metaphor that we wanted to use for dealing with this. And we said, hey, why don't we use a contract? And so we kind of stuck with that. And so when we do set up these contracts, we assign them. In this case, we're looking at the contract account as opposed to a billing account or a delivery account, and we'll take a look at each of those. But those are the three account roles that we track in terms of advanced contracts. And then we establish the contracts themselves, and then the addendums underneath the contract. You can have as many addendums as you wish. The addendum is going to have different billing and delivery accounts assigned to them, so that we're not limited in that regard. And it really serves to handle a lot of different situations that you'll run into, and especially for complex ownership arrangements or organizational arrangements that you'll see at the customers that sales are made to. One thing you'll note is if I come in and look at finished at this contract account level, I see these are the elements that are associated with that account across all contracts. And then if I go into this particular addendum, I'll just see the four that I'm looking for. So what's nice about this is we can always look at what we've sold to a customer across all of our contracts with that customer. So without further ado, let's come up to this contract. We're going to look at the contract level first. One thing that we've done with setup, you can see there's quite a bit of information here that we're gathering. We'll look at some of the key points in a little bit, but we've got a lot of information here, and we've done this in a way that allows us to specify a contract type that really goes a long way to filling in all of this information. Makes setup very easy, makes integration much easier as well. All we need to do is provide the contract type, and so we'll know what the key terms of that contract need to be. We see some general information here. We identify the sales opportunity. If we're using Salesforce.com, we've integrated to that pretty much. I'd say in 90% of the companies that we've implemented this and predecessor products into. We've got a customer reference in terms of a PO number. This is all stuff that can end up on the invoice. We establish our contract account, and again, this is the customer who has executed the contract with us. We specify a contract manager or sales representative. We can establish pricing group if we have specific pricing that we want to apply, and then we track a number of dates, including the effective date of the contract and the date it was executed, our expected start dates, our actual start dates. Our term dates will actually track the term of the current contract, so as we renew, we'll see those dates change. We specify for recurring elements, we gather a good deal of information about how we're invoicing that. So what is our service period interval? In this case, we're talking about annual. We have a 1-year contract. We've specified that in terms of billing, we're going to be billing on an annual basis, and there'll only be a 1-year interval, meaning that we're going to bill every year. And then we specify how we're going to recognize our revenue for recurring or scheduled type things. In this case, it's going to be based on a month, and we're going to recognize revenue every month. We can establish particular calendars to take into account. That's useful in a lot of different situations where when I need to control my revenue dates, be it weekly or semi-monthly or maybe I'm bi-monthly. It's been a useful thing. We specify the same things for our renewal periods, so we can have a different initial period. Our initial and renewal periods can be handled differently. This is useful if you have an introductory period, say of 3 months, and then as it renews, it'll renew into an annual, or if you need a 2-year contract or a 3-year contract, you can do that. So once we have our contract established, we can take a look at our addendums. In this case, from the contract, we've got 2 addendums on this contract. We'll go into the second one and take a look at that. So we can come in and edit that. So what we see here is a lot of the same types of information. This will cascade down from the contract automatically and can be overridden at the addendum level. So won't go into a lot of this stuff because we will have already talked about it. A couple of key things that I will look at, though. First, in terms of holding our revenue scheduling and our billing scheduling, we can do that here, as well as suspend posting. So if we have a situation where we have to stop our revenue posting process for whatever reason, we can go ahead and do that. We also maintain a fact box looking at, in this case, at the addendum level, so we can see what our sales booking has been, any leakage off that sales booking, and then leakage we define as a situation where we may have done the sales booking and for one reason or another we activated on the contract, but we didn't activate all elements. Think of activation in terms of delivery, a point at which we can start earning revenue. If we've got if for some reason some elements aren't able to start at the same time as others, we are now in a situation where leakage will occur. So leakage, again, we define as the loss of revenue because of a situation where we've activated some but not all elements on a contract, and as each month as we go through each month from that point, we'll lose a month's worth of revenue. That'll serve as a negative entry against our sales booking, and will be adjusted to, based on when we finally do activate those elements. We'll all be caught up with our actual booking, which takes place as we deliver. So again, really useful, good for especially if you've got an analyst calls and the like. it's really useful to have that breakdown. That comes to our net booking, any adjustments. It comes finally to our expected revenue, and then we'll track our earn to date and our remaining revenue as well. If we're collecting costs, and I don't think I've done that here, we'll also maintain a gross margin. So things that, in terms of our plan, let's look at our elements right now. Well, so I've already set this up, and we do that by establishing our billing register and our revenue schedule. Those are two separate schedules or registers that we maintain. We do maintain linkage between billing lines and revenue lines, so we can track them back. It's useful if we have to reverse anything. We know which lines to reverse in terms of our revenue when we reverse an invoice. We want to look at control. We can look at the billing register for this. So what we see here are really two lines. The first line relates to our one-time elements. So these are the things that build in advance. So we have a router and the firmware. We see that that's a total of $3,400. Again, the firmware is here. You can see that it's carrying a zero price. And then our second line deals with our warranty and the management application, which is based on a SaaS model. So we'll see those. We're seeing this, again, this is billed annually, so we're going to just see one set of line items for our billing. It bills in advance on an annual basis. If we had broken the subscription down to a monthly billing, as we see quite often, you would see in this case 12 separate lines. If we had stub periods, you'd probably see 13 or 14 lines depending on how it was configured. The nice thing about that is we do that at runtime, so we can decide how we're going to actually set it up. We maintain default settings at the item, but then come back. So that's the billing register. When we go to our revenues register, we'll see here that we've got, first one is $3,400, and we see that we've got enabled $3,400 on this. The firmware is omitted from posting because we obviously can't post a zero item on the revenue register against our ledger, so we omit that from posting. If we look at the next line, here we're seeing just the warranty. So we had some adjustments, or it basically our process canceled the first set of entries and then enabled the next. We can filter these down, which is nice. So that if I only want to look at created and enabled, I can. So that we see what we've got out here. And this is basically, you'll see different amounts, and that's because we're using actual dates, actual month-end dates and the number of days in each month in this configuration. We're also can also do this on a 3360 basis. It's a system level parameter that we can set for that. Okay. So once we've done that, I mean, you can see that we've got the schedules. We can look at our elements if we like, and so we'll see here. You know, we maintain our contract value, so we can see the $3,400, the $900, and the $1,200. We don't have a contract value for the firmware. We can see that they've been set up as one-time elements and recurring items, respectively. So as we renew, we would expect that the warranty and the management software would actually, when we renew, we would see these amounts come back to us at the $900 and $1,200. We do take advantage of AX's trade agreements, so that if we had, and we've augmented that to account for at the contract level. So that in the event that we had a price escalation clause in this contract, we could specify that pricing going on into the future, and we would get a different return on each of these, so that we could in subsequent years we would see the escalated pricing. We'll take that into account for contract value as we go forward as well. So with that, I'm going to switch back to the next example. So we're going to look at the at our back to our slideshow, and I'm going to move to the next example. Oh, not too far. There we go. So in this case, we have a software example where we've set up a perpetual license for a software platform. We used SKG's treasury automation platform. And part of that, and the way we're setting it up, is that we've defined that there's a fixed portion of that as well as a usage-based royalty based on the banking transactions over a count of 60, and we're billing those in arrears. So what I want to show you on this is specifically the initial setup. I won't go through the contract and the addendum information. We'll just go to the elements and then show you how we'll take on usage and what that will look like. So let me switch back, and we're going to go out of this. So let me switch back to AX, and we're going to come in. Oh. I'll have to beg your pardon. I lost my connection there, so I'm going to stop sharing it and get myself rebooted. It'll just take a moment.
So Patrick, just to jump in here, if you did lose your internet connection, once it comes back, it should just pick right back up.
Yep, I think I'm good. Let me just make sure. Yeah, I'm good. So let me share that out again. Okay, great. So again, I'm going to go back to that tree view that we were looking at. And so here we are. This is going to be under a different customer. We're going to be under active transport for this one. See, we have a number of contracts, a little bit more that we had there. We can see that again, you know, a fair number of elements underneath there. We're particularly interested in this guy, and we're just going to go to the elements for that. So we see, we'll go to that element setup for here. There, I want that one. So let's look at the elements for this. Should have two here, so let me, oh, I know why. Okay, so let's go to the addendum instead so we can see all of them when I come in here. So this is our addendum, and we want to look at the elements. We'll look at these two elements that are here. See that we've got a one-time element, that's our perpetual license, and then metered activity. So when we set up those schedules, what we should see here in terms of the billing register is, let's just look at the enabled. So we have our $12,000 as far as a schedule on this, as you might expect. And then on the other element, we've done 1 month of activity at this point. So if I look at the billing register for this element, I also see that. I didn't have a price on there, so I apologize. But so we'd see this as we go. The way we get that metered activity in is really we use a periodic schedule, so it's very easy to integrate with external systems. That would be in our metered activity, which is a periodic deal. And we can see here that we've got, I had a sales quantity of 100. So they had 160 total units, 100 of which would fall over the 60. And then we would, so we're transacting 100 units, and we can add as many as we need to these. So it's just a matter of popping this in. So again, if we come to this, and let's make sure I'm using the right guy. I want this one. And again, I'm going to pick up, it'll only pick up those elements on that addendum, which is the contract and the addendum. We see that here. It'll only pick up those elements that are identified as metered activity. And then we'll come in, we'll give it a date. So this would be for the next month, perhaps. And that'll go to 29, and let's say that's 200, just to make it interesting. And then we would basically commit this. So it's gone to the billing register. And if I go back to that addendum, and let's go down here, and we look at the control for that, I should see a second line item in there for the billing register for the next period. Let's take another look at that. Okay, and then there we are. So there's our billing register for that. Again, sans pricing, but we picked up our sales quantity of 200. So this would happen each month. The system would treat this since it's and this is a good case in point, since this is a metered activity against a license of IP. We would actually transact against that and increase our transaction price as we see the usage happen. That would be as opposed to a subscription element that wouldn't behave that. So, so that again, it's important to know how things are supposed to work in terms of the way you set that up. So as opposed, we would set that up as a usage against an IP license as opposed to usage, say, against a subscription where we're paying, let's say, if the typical example is the cell phone where you have a data plan, and the data plan, as you exceed the limits of that data plan, you would have usage against that subscription. That would be different, and you'd have to actually have an estimate of what you expect that to be for revenue recognition purposes at the inception of the contract. So let's wrap up, and we'll come back to the slideshow, and we have just a couple of things that I want to run through as I find my cursor again. All right. About that. Sharing. Okay. So a couple of points I want to bring home. First, with regard to revenue allocation, there's a difference between what we've done in legacy and what we're doing in ASC 606. So in legacy, it was important when you allocated your arrangement consideration to the deliverables that you determine a relative selling price. And that relative selling price had an order of precedence to it. If you had VSOE, that's what you used. If you didn't have a VSOE, then you were required to look and see if you could determine third-party evidence. What are my competitors selling this at? And if you couldn't get a result from there, then you were to use the best evidence of selling price, so or best, which was an estimate. Certain types of elements, software in particular, required VSOE. Others, you could use VSOE or TPE, so it's very prescriptive. In ASC 606, you use more judgment. Here we talk about allocating a transaction price. It's kind of the same thing as the arrangement consideration. They just changed the terminology. So we want to do that to obligations. So we have to, in order to do that, you want to determine a standalone selling price for each performance obligation at contract inception. If you don't have something that's observable, then you make an estimate. So when you're estimating that, you can look at adjusted market assessment approach, which is basically looking at your market and you know, this is what you've come up with as a price. And to the extent you can see this, I know it's an eye chart, but we actually can maintain either, so ASC 606 and legacy. So we would actually come up with our observed price or an estimate, and then we would choose which kind of estimate did we use when we selected this. And you could certainly attach any kind of analysis to each of those lines using AX's document management. So adjusted market or expected cost plus margin. So what does it cost me? What's my reasonable margin for this? That becomes my price. And a limited residual approach. So if you've established your observable price or your standalone price is what results from this. For everything else, and you need and so what you're left with would be the residual value of the remaining elements on a given contract. So we try to set these things up ahead of time as much as possible so that we can use them in our allocation process easily without having a lot of runtime issues. Next, in terms of the product and our automation features. So when we onboard orders, we establish a contract hierarchy ahead of time and then templates to streamline that with our contract types and element types. Element scheduling, I should add in terms of onboarding, we've integrated with CRM, we've integrated with Salesforce.com and other proprietary upstream systems when we've done this. And generally speaking, if you've got any volume, that's what you're going to be looking at. In terms of our element scheduling, when we add those elements in, whether we've taken them from upstream or an operator is actually entering them, we'll create our billing registers and our revenue schedules accordingly. And then as we activate those elements, we'll take another look. So if I'm activating an element later than I expected, I'll actually adjust that billing register and revenue register accordingly in order to maintain a coterminous element schedule with that contract. So we don't want to extend beyond the contract terms with any of our elements. So we'll adjust the schedules. We take a delivery notification, and that would be, we can take that from upstream, again, with services, and take that delivery notification and then activate based on that. So we have batch processing that will they'll run as often as we need. Generally, it's nightly. We can activate against the notification on a daily basis or more often if necessary. And then that would allow us to then execute against that billing register and create sales orders or project invoices as the case may be, or as well as recognize revenue and any leakage against bookings. Again, invoices through sales orders or projects, and in terms of revenue recognition, we'll allocate the revenue against the delivered services in the contract. We can choose whether the revenue would be recognized prior to invoicing. That's less of an issue now. The new guidance actually pretty much requires that at least in terms of the total contract, that you've invoiced enough to cover any revenue that you're earning. Naturally, there's some things in terms of constraining revenue in the for whether it be because of collectability issues or others that we can deal with. And then subscription management. So let me, in the interest of getting through this, go to the next thing. We talked a little bit about contract setup. You saw those screens. No, you can't probably read the pictures, but a couple of points that we want to talk about a little bit. Again, we have predefined contract types to streamline the setup. We have fact boxes that provide contract-to-date snapshot of bookings and revenue. We can establish the contracting, a billing, and a delivery customer role and assign different customers to each. Within the given contract has the contracting role, we track the billing and the delivery roles at the addendum level. So we have a great deal of flexibility with regard to that. We support price escalation using AX's trade agreements. We can track expected and actual start and expiration dates. We enforce co-termination based on the first activation on a contract. We interface with the sales orders as well as projects. We identify the service period that's useful for billing purposes. And we can establish billing cycle dates or fixed billing dates if your customers basically put you in a position where you need to, if they want to be billed on the 12th of the month, they get billed on the 12th of the month, regardless of what the cycles are. So we can handle that, and we'll handle the accounting properly for that. So let me go on to the next one. And again, at that element level, we inherit the setups from the contract setup. We can override those at the element level. Again, fact boxes. The tree view that you saw presents elements at various levels. So if I want to see for a given customer what I've sold them across all contracts, I can get that information. We maintain promotional as well as trade discounts. We can specify those at the element level. So if you have a specific promotion that you're running, we'll treat that as a discount, complete with, we can actually set that up so that it's got different accounting if you need it to be. We will use, we support the use of predefined order packages or kits and quite effectively, and can apply the sales price on the kit against the individual components when we break out the element schedule. So we'll do that on a weighted average based on the price. I think that's probably all I need to get through. I'm going to give you back to Scott.
Thanks, Pat. So it looks like we're pretty close to the turn of the hour here, so we may not have time to take very many questions, but if there are any questions that we can't get to on the call today, we're more than happy to answer questions on a follow-up basis. In fact, I'll provide my email address. That's Caudle, SCAUDLE, at sksoft.com. You can email them to me directly, and I'd be more than happy to respond after today's presentation.
All right, we do have a few questions that have come in. We can try to get to them. Those we don't, we will also save a transcript of those, and our presenters can follow up that way as well. So let's get right into it. Is what you were showing today related to the project module, and what are invoice destination options?
Yeah, everything we saw today will relate to the project module. We'll pass billing register items to the out to the project as a project invoice or project invoice lines, and then the project invoicing process will take over from there. Not the second part of that question. In terms of destination, we're going to use the billing. However we've set the project contract up will control the actual invoice destinations.
Okay, in the first example, the RevRec overtime was discussed, but the amortization of related costs over time was not discussed. How is this handled?
Currently, we've got that on our roadmap to bring in the actual cost. That's not it's a reference in 606. I think it's actually 840 that dictates that. It is something we want to add to the product. It'll probably be a next year item.
Okay, I see we're at the top of the hour. Scott, Pat, do you have time to answer three more questions or so?
I'm good.
Sure.
Okay, great. So someone asks, TriBridge has a product named ACM. Is there a relationship? And also, how can I get a copy of it? Okay, and how can I get a copy of this presentation to share with our RevRec team? So please go ahead.
Sure. So there is a relationship, and so there is a relationship between SK Global and TriBridge in terms of the ACM, and so SK Global, as will be announced in the press, you'll see this publicly announced, has an exclusive distribution right for that IP to the reseller channel and to the Dynamics community. And I think the second part was getting a copy of the presentation, and we can arrange that. If someone will send an email, we can arrange to provide some of the information today.
And we are recording today's event, so we'll be able to make that available.
Correct.
Okay. Can you talk about the availability of this solution for AX7?
Sure. So the short answer is it's coming. It's actually in development right now, and so I can't give specific dates, but it is under development right now with the development team.
All right, and is there an option to consider a topology where an integrating system handles the billing and not AX?
I'll take that one. Yeah, in fact, we've actually done the reverse, but the would be a fairly simple matter. We'd simply have to bring the invoicing in to AX as having already been invoiced. So we maintain status on the billing register, and so it's just a question of how we actually initialize those items. We have some system-level parameters that allow us to specify that with regard to the integration. So we would bring that in that way, and then calculate the revenue register, and then recognize revenue as needed.
Okay, great. Well, that is the last question in the list for now. I want to remind folks as we do wrap up today, you'll see a quick survey that pops up after we leave. We really appreciate your feedback there. It just takes a couple seconds, and it gives both ourselves and all the speakers some really helpful feedback. So in closing out today, Scott and Patrick, thanks so much for your time.
Thank you.
And thanks to everyone in the audience for your attention, for the great questions. We did record today's event once again. We'll be making that available within the next few days. With that, we're going to wrap things up. Thanks, everyone, and have a great day.